Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get into it. Today we're looking at a document called U.S. Market Peripheral Notes, dated for Friday, March 20th, 2026.
And just so we're all on the same page, this video is a direct informational narration of that source document. We're sticking right to the text.
So here's our roadmap. We've got 6 sections to cover. We'll start with the market's performance, which is described as a washout. Then we'll dive into the derivatives market, dubbed the bull graveyard. After that, we'll look at sentiment and fund flows, the bigger macro and geopolitical picture, and a really specific case of corporate risk with SMCI. And finally, we'll wrap it all up with the strategic conclusion and guidance from the report.
Okay, Section 1, Market Performance, or as the subtitle says, a washout. It seems the triple witching session, that's when a ton of options and futures all expire at once, turned into a complete one-way street of selling. It was a perfect storm, really. You had huge geopolitical tensions meeting this massive options expiry, which created a nasty feedback loop where there were just no buyers left.
And you can see the damage right here in the numbers. The S&P 500, down 1.5%, and it completely sliced through its key support at 6,500. The Russell 2000, which is always sensitive to interest rates, got hit even harder, dropping 2.2%. The big news here is that both the Dow and the Nasdaq are now officially in a correction. That means they're down 10% from their highs, which is a really big psychological blow to the market.
But here's the part that really tells you what's going on. A full 3/4 of all stocks in the S&P 500 closed lower. This wasn't just tech or banks having a bad day. This was a systemic, across-the-board exit. When you see that kind of broad selling, it's not just a pullback. It's a sign that the big institutions are in a full-blown cash-raising phase. They're selling whatever they can at whatever price they can get.
So that brings us to Section 2, which has a pretty ominous title. Derivatives, the bull graveyard. We're about to see how a massive options expiry didn't just contribute to the decline. It poured gasoline on the fire.
And here's the number at the heart of it all, $5.7 trillion. That's the staggering size of the options expiry that was going on. This event basically became the core driver of the sell-off. These market makers have to stay delta neutral, and the mechanics of that forced them to sell more and more stock as prices fell, which of course just accelerated the whole downward spiral.
Let's break down exactly how that worked. Think of it this way. There was this huge dam of put options built up at the 6,500 level on the S&P 500. It was supposed to be a major support. But once the market broke below it, that dam didn't just spring a leak, it completely burst. All of those market makers were suddenly forced to sell stocks like crazy to hedge their positions. The very structure that was supposed to provide stability turned into a waterfall of forced selling.
So what does this all mean from a technical standpoint? Well, the market is definitely what you'd call oversold. In the short term, it's now testing some really important weekly support levels. But, and this is the big so what, the report is pretty clear. Any bounce from here should be treated with extreme caution. This is likely what they call a dead cat bounce, an opportunity for trapped sellers to get out, not for new buyers to jump in. The primary trend is now firmly down.
All right, let's move on to Section 3, Sentiment and Fund Flows. And what we're about to see is a serious mismatch in how regular retail investors and the big institutional players are seeing things. Just look at this gap. On one side, you have retail sentiment. The fear and greed index is at 15. Yeah, that's extreme fear, but we haven't seen that final throw-in-the-towel moment of capitulation from everyday investors. But then you look at what the institutions are doing, and it's a completely different story. Long-only funds just executed the largest equity sell-off ever recorded. The pros are running for the exit.
And this is absolutely critical to understand. This isn't just institutions hedging their bets a little bit. This is genuine position liquidation. The report argues that this marks a structural shift. The big money has decided that this isn't a short-term problem, it's a long-duration macro crisis, and they are repositioning their capital accordingly.
Next up, Section 4, Macro and Geopolitical Conflict. The external pressures are escalating, and the report says it's creating something of a liquidity black hole for global markets.
A huge part of this is the grim reality of a zero-flow situation in the Strait of Hormuz. We're talking about a potential shut-in of 12 million barrels of daily oil production. When that much energy is taken off the market, it sends shockwaves everywhere. At the exact same time, bond yields are surging. The 10-year U.S. Treasury yield shot up to 4.38%.
When the so-called risk-free rate of return gets that high, it puts intense valuation pressure on stocks. Why take the risk in equities when you can get a solid return in bonds?
And what's the combined effect of all this? The market is now pricing in a 50% probability of an October rate hike. Just think about that for a second. The economy is showing signs of trouble, yet the Fed might have to raise rates to fight this new wave of energy inflation. That is the classic definition of stagflation, and it's a nightmare scenario for markets.
So here's the bottom line. When you see everything being sold at once, gold, bonds, and stocks, it's the market entering what the report calls the final stage of cash is king. In the face of this kind of stagflationary threat, investors are fleeing every asset class and piling into the safety of the US dollar.
Now for Section 5, where we zoom in on a specific corporate risk situation, the SMCI case. This is a perfect example of how, in a really fragile market, a problem with just one company can act as the catalyst that breaks everything.
So let's get into the details of this SMCI case. You've got 3 defendants, Liao, Chang, and Sun, accused of some pretty serious criminal conduct. We're talking about circumventing export controls to smuggle high-end tech, and even faking servers to try and fool auditors. And the amount of money involved here is just mind-boggling. $2.5 billion in NVIDIA GPUs.
The report is blunt, saying SMCI's claim that it was unaware of all this appears highly unconvincing under professional audit scrutiny. The market reaction was swift and brutal. The stock plummeted by 1/3 in a single day. And because SMCI is a component of the S&P 500, its collapse created a ripple effect, forcing index funds to sell and adding yet another layer of selling pressure on the entire market.
And that brings us to our final section, Section 6, Strategic Conclusion and Guidance. The takeaway here is that the market has hit a major inflection point. When you're dealing with geopolitics, energy shocks, and stagflation, the old rules don't apply. Defense is now the only viable strategy.
So what does that mean in practical terms? The report offers 4 clear guidelines. First, avoid the temptation to bottom fish or buy the dip. It's just too early. Second, hold cash. It's your primary defensive asset right now. Third, monitor those critical geopolitical signals coming out of the Middle East. And finally, the 4th point, don't even consider re-entering the market until you see a confirmation signal, like the VIX, the market's fear gauge, spiking into that 30 to 35 range. That's the sign of true capitulation.
To sum it all up, the core message from this report is this. The market's governing logic has now shifted from growth to survival. It's a powerful statement. The game has changed, and right now it's all about preserving capital and waiting for the storm to pass.